Well, hello everyone, and hope you're all having a great Wednesday. This is Jean McDowell with TradersCoach.com, and welcome to Wednesday Night Live. Just a few things to show you on the webinar platform. We have a questions area, and if you all would just type in hello or maybe the city you're watching from in the questions area, that will let me know that I can my voice is coming through and you can see the webinar screen, and that would be great. And while you're typing in the questions area, I'll just mention that we love questions, and this is where you can ask the speaker questions about tonight's topic. All right, well, looks like everyone's joining in and saying the sound is a-okay. And hello there, James, and hello, Chris, and hello, Bill and Lynn. Good to see you all here. The topic for tonight is Elliott Wave, and I know we've got lots of big Elliott Wave fans here. Bennett will be going over how Elliott Wave is the roadmap of the markets, and Bennett is an expert in Elliott Wave techniques and trading psychology and money management and more. And Bennett, without further ado, I will turn it over to you.
All right, well, thank you, Jean. Great to be here. Welcome, everybody. It's great to be back on Wednesday Night Live. You know, we cut these back to once a month, especially during the summer here. So it's good to be back on here in front of you. And we do these, what I think on the last Thursday of every month now. So cool. All right, well, today we got a great topic, Elliott Wave, the roadmap of the markets in the universe. Now, if you see me trade, you know that I use a combination of our software tools along with Elliott Wave, along with Fibs. Those to me are some of the most important aspects or connecting of the dots that I do when I actually consider a trade. And then of course, when I'm in the trade of what I want to do with the trade. So Elliott Wave's a big one. All right. It's the roadmap of the markets. So this is kind of a fun topic to discuss that really is quite amazing because it's really, I think, one of the best forms of technical analysis to really figure out what market cycle you're in. All right, now before we get going, a quick thing on the risk involved in trading. I think most of us here, and I'm looking through the laundry list of who's here today. We got a great turnout, so good job, Jean, getting everybody here today. But first of all, you know, I think you kind of understand there's risk in trading. It is possible to lose some or all your money trading with financial markets. But, you know, we try to curtail that as much as possible with risk control. Not every trade works. So we try to cap those losing trades to a certain percentage and let the winning trades win more than we lose. And that's how we make money in combination with winning just more than we're losing, period. But it's kind of important to know how to do the risk control aspect of the whole game. Now, also too, check with your financial advisor, accountant, or attorney before implementing any ideas because they know your personal situation, and of course, we do not. So it's important to do that, and then always trade with risk capital. So those are the kind of the biggies. And then the next thing, well, Jean already introduced me. We probably should update this picture. I'm not quite as young looking as I used to be, but in any case, come visit us at traderscoach.com at any time. And you know, we've been doing this a long time. We actually started traderscoach.com back in 1999, and I was trading probably 10 years before that, easy. And here we are today. The interesting thing is, back in the early 1999 period, the internet was not like it is today, nor was websites. So back then, I was trading a lot, managing a lot of money, and also coaching students, which is why we called the website traderscoach.com. And it was primarily a place to text chat with me. I had certain clients that I was coaching. We used the telephone and then we text chatted, exchanged charts that way. Now, of course, with the technology, I can talk to them just like I'm talking to you. We can share screens. They can cut their mics on. So it's a whole different ballgame than what it was like back then. And we've been doing this, you know, we did all the trade shows. We used to take the big, huge double boosts, cost us a fortune at these trade shows, but boy, did we have a lot of fun. And we got our name out there and got well known. We got book deals. the whole 9 yards. And I also eventually did all the trading challenges for Inner Show, which ran all these particular things. And then I was on a bunch of panels and speaking engagements. So we were kind of busy getting the name out there, and it was very successful and a lot of fun when we did it. But the trade shows aren't quite what they used to be, simply because everybody's online now. So the online is kind of where it's at now, and I can understand that. But what fun we had. All right, so in terms of books, I've got a lot of books available out there. The Money Management for Traders book on the far right-hand side is my newest one. We just are signing contracts actually today. That's no BS. We got the contracts today, so we're actually working on our second updated book on the art of trading from Wiley. And we're going to be doing that. So we're pretty excited about that one. And you can check out all our books at Amazon. But if you need help with risk control, Money Management for Traders, the new one on the far right, great book. It's about 15 bucks. And you can't beat it for the price. Comes in audio, Kindle, soft cover, hardcover. And it basically gives you what you need to know to implement a good risk control program into your trading environment. All right, now, we also like to always give somebody, the people that took the time to attend today, something free. And this is a chance to get your free cheat sheet on the Elliott Wave. So definitely check that out and use that link. And Gene will put that link in the chat area, make it nice and easy for you to click on and get the free cheat sheet. And then you can print that out and keep that right on your desktop, okay? And that's kind of cool. All right, so let's keep going here. And then the next thing I want to talk about now is a little bit about the history of the Elliott Wave. You know, who the heck founded it? Well, it's founded by a guy by the name of Ralph Nelson Elliott way back in the early 1900s. He was born in 1871. He actually was an accountant, all right, almost died. All right, he got pretty ill. Back around the 1929 period, he actually started studying the markets when he was sick. So if he never got sick, he probably would have just been an accountant all his life. But he got sick, so he kind of was in bed and he couldn't really do his job. So he was very interested in the stock markets and the Dow theory. So he looked over tons and tons of paper charts. Now, don't forget, back then, they didn't have the internet. So charts actually came in delivered in paper, and certainly not used for anything that quick, but nonetheless, that's what he had got, and he looked at different patterns that he saw in the markets. And he noticed, after doing this for quite some time, that markets moved up and down in trends. And these trends were represented by certain patterns in the market that we call waves. And he noticed basically that there were 5 waves in a major trend, either up or down, interrupted by some corrections. So we'll talk about that in a minute. And he called this the wave principle, and it was about 1938. He wrote a book on nature. Well, that's where he really started working on the wave principle. And then his final work was published called Nature's Law in 1946. And unfortunately, he died just a couple years later. All right, so he's the guy that's responsible not for creating the Elliott wave, but for observing it. And a great way to look at the Elliott wave is kind of when you think about astronomy, what astronomers do. You know, they notice things in the sky. For example, they'll see a black hole. Now, they don't know how it works, but they observe that when objects get close to it, they disappear, never to be seen again. And there are certain, you know, density in the whole 9 yards. And so that's observational science, very much like what Ralph Nelson Elliott did on a much more basic level using paper charts. And so he observed these patterns, didn't create them, but observed the reoccurring patterns. And so basically, you know, fast forward today, it's still in use today, and we have very fancy computers that help us do this. But the idea of why to use the Elliott wave is because we like to use it to figure out where we are in the market. What cycle are we in? Are we in a correction? Are we in an impulsive wave? So it's used also for forecasting price movement for profit, because that's why we do this, right? To make money. So if you're in a corrective wave and you know that the trend is not in and you're going to have one more significant wave up, then when that correction ends, you can go long or buy that market, and that's how you make profit. Now, the Elliott wave encompasses mass psychology, and so it is a form of technical analysis, not fundamental analysis, but it basically is looking at price structure in the market along with certain things that we measure what's going on with that price structure, like momentum, volume, things like that. All right, so in terms of price target zones, we have to bring in the Fibonacci extensions and retracements to help us with those, but how we anchor those using the Elliott waves becomes vital for producing high probability target zones. And we'll talk about that. And then, of course, your risk to reward expectation calculations can be based depending on if you're trading a correction or impulsive wave and where to put stops and so forth. So I really love the term that the Elliott wave theory is the roadmap of the markets, because it really is. It really gives you a good idea of where they are going. All right, so the Elliott wave principle, like I said before, is a form of technical analysis, and it's used by investors too, not just active traders, to forecast trends in the financial markets and other collective activities. The wave principle states that collective investor psychology, also known as crowd psychology, moves from optimism to pessimism and back again. These swings create patterns as evidenced in the price movements of a market at every degree of a trend. Elliott's model says that market prices alternate between 5 waves and 3 waves at all degrees of a trend. And so when a trend is in motion, it's 5 waves, and then it goes into some form of an ABC correction, and that's what he's saying in that particular situation. All right, so here's an example. This is actually Apple stock, a very, fairly decent couple years ago, where I just thought it was a great example of the Elliott wave, and actually also the waves inside the actual major waves. So in the Elliott wave, we have the major movements, and then we have smaller movements inside the major movements. And basically, in the Elliott wave, what Elliott discovered was that waves 1, 3, and 5 are all what we call impulsive waves. So they move in the direction of the optimistic cycle. Waves 2 and wave 4 are corrections in that particular trend. So there are 5 waves in a trend, and when we get to the top of wave 5, the trend ends, and you can see that happening here. So when you think of an Elliott wave, I want you to think of it as 5 waves: 1, 2, 3, 4, and 5. And then I want you to think of waves 2 and 4 being corrective waves. Now, inside wave 1, there are 5 smaller waves, and this is one of those rules that just make up the Elliott wave. Again, this was a rule that Ralph Nelson Elliott discovered by observation. And he found that there are 5 waves in a wave 1. And if you can't see them on the current chart you're looking at, if you go to a lower time frame, you'll be able to see them more clearly. But on this chart that I'm showing you now, we were fortunate enough to be able to see the smaller waves on the same chart that we could also see the larger waves. So I'm going to circle the larger waves and then take a look at what the smaller waves are. So here's 1, 2, 3, 4, 5. So there are 5 waves inside each impulsive wave. And if you think about it, what he said before in that sentence that I read you in the previous slide was that after 5 waves, you go into an ABC type of correction. And that's exactly what happened here. After wave 1, or the 5th wave inside, you have an ABC. Then the pattern starts again when you go into the new impulsive wave. You have 1 wave, 2 wave, 3 wave, 4 wave, and then 5. Then you go into the ABC correction, which forms wave 4. And then you have 1, 2, 3, 4, 5. This is just a fantastic example of an actual live market in this Apple, okay, of being able to see the minor wave inside the dominant wave. And it's great because when you go to draw fibs, you know, if you draw a fib extension between 2, 3, and 4, you can kind of then figure out where wave 3 is going to end. So by going inside inside the smaller waves, that will help you determine where the larger wave will end. And if anybody has any questions, feel free to ask on that, okay? So that's just a great example there. All right, now, the other thing we do today, because we have all this computer power and so forth, we have other ways in which we can measure the dynamics of an Elliott wave. And we do that through momentum measurements, volume measurements. And this was not quite available as much to Elliott back then. Yes, price on a chart was, but momentum wasn't readily available back then to him. So he focused mostly on price and price structure and the math behind that. However, there's a whole dynamics inside the Elliott wave that deals with measuring momentum. You know, the highest momentum and the highest volume is on wave 3 and things like that. So when you combine the classic Elliott along with, and that's Ralph Nelson, along with the modern Elliott wave theory, you really are putting the odds in your favor of being able to identify where you are even better than just using the classical approach. So, you know, again, when we talk about the classical approach, we're talking about wave structure. And this is this thing where there are 5 waves in one wave, wave 1 up, then we have an ABC correction to the downside. And if this is a monthly chart, if we went to a yearly chart, so a month, even though we see the smaller waves inside the monthly, guess what? This wave 1, which is the major, and a wave 2 on the monthly, actually becomes the smaller waves on a larger time frame because there's waves inside waves. Then if you go to a 5-year chart, you see the same type of thing. These waves then become the minor waves inside the primary wave. So that is an observation based on the classical Elliott wave approach that Ralph Nelson Elliott discovered, that anytime you have an impulsive wave, no matter what time frame, there's always a time frame either under it or smaller waves inside it that are represented there. And so that's one of the key things to take away from that slide. And then here's a simplification of those 5 waves here. But you know, I showed you these already in the Apple chart. So same type of thing. All right, now what we haven't talked about is corrections. We talked about the 5 waves in the impulsive waves, and you can see that on this chart here. Here they are. Wave 1 is impulsive, the 5 waves for 3, and the 5 waves inside 5. But what about these smaller areas between 1 and 2 that represent the correction? Well, those are normally an ABC pattern. Those are the smaller waves inside the time frame you're looking at. So, for example, if we're able to see wave 1 and we're able to see wave 2, like on that Apple chart, then you could see the ABC correction inside there. Sometimes you can't see it that well, but usually you can. And so those then are the smaller, that ABC that makes up wave 2 and wave 4 are the smaller waves inside those. So impulsive waves have 5 waves, corrections have 3 waves, A, B, C. Now, if you really want to go down even further, because there's always waves inside waves, what direction of movement is between 1 and 2? Well, in an uptrend, that's down, right? So in an uptrend, A wave is down, B wave is up, and C wave is down. So if you go down to that minute level, technically A wave is moving in the direction of the larger time, which is 2. So that is actually an impulsive wave on a corrective series. So you can expect to find 5 waves in A wave if you go low enough. And then ABC for B wave, and then 5 more waves in C. And yes, in here, there'll be 5 waves too. So you can really go down the rabbit hole on this in terms of the waves within inside the waves. But technically, that's the way the Elliott wave works. Always waves within inside waves. And whatever the wave, major wave count you're looking on the time frame you're on, then any movement in direction of that major count, okay, is going to be made up of either an impulsive wave or an ABC correction, with A and C wave having 5 waves in them because they represent the impulsive wave on the correction. All right, that type of thing. All right, here's just a little bit more example of both the bearish and bullish scenarios on corrections. Now, there's different types of corrections. Pretty much 99% of the time, every time I trade, if a market's going into a correction, there's no way of knowing if it's going to be complex for the most part or just a simple ABC. There is a rule out there that says if wave 2 is simple, wave 4 will be complex. If wave 2 is complex, wave 4 will be simple. And that is true, but that doesn't necessarily mean that the pattern will be a complex pattern. It could also mean it just made the ABC pattern maybe slower or deeper on a 2 and then be briefer on a 4, more brief, okay, that type of thing. But there are also situations where you do not have an ABC, that you have a more complex unfolding correction, usually occurring in wave 4, sometimes in wave 2. How many of you have seen a bottom, okay, and then it springs off the bottom and then goes sideways? Okay, that can be sometimes a complex wave 2. All right, so that happens. But for the most part, when you're trading the Elliott wave, you always assume it's going to be an ABC because you can't really always tell when it's going to go into a super complex correction. And a super complex correction is going to look something like that. Usually where you see pennants in the market, that's where you have a complex correction. And you're not going to know it until you see wave C fails, okay, and doesn't go down to where it should to end the correction. But instead, we start to see channeling, and we have more of a pattern, an A, B, C, D, E type of thing. So this is called a triangular complex correction. We also have flat complex corrections. So it all depends on what happens after C wave and whether it stays channeled or goes into a pennant or gets real messy. How many people have looked at a chart and they can't make heads or tail of it in terms of the Elliott wave because it's so messy? That's because it's in a complex correction. So it's very difficult, all right? And there's irregular corrections. Now, the interesting thing about this is the irregular corrections, you have a very extenuated B and C wave on these, and then it usually unravels from there. All right, so there's a lot of criticism on the Elliott wave out there. A lot of people feel it's very subjective, and I think they feel that way because they don't really understand how to do it right. They don't understand the concept of the waves inside the waves and how that can help you take the subjectivity out of what you're looking at. If you can go to a lower time frame and count the waves inside the waves, that gives you a more definitive situation of whether the current chart you're looking on is an impulsive wave or a correction, and if so, when it should end by using fibs and so forth on the smaller wave count. So all that kind of stuff comes into play, and it's just a lot of people that try to tackle the Elliott wave really don't study it thoroughly enough. All right, so the goal of counting Elliott waves is clarity. You want to take the subjectivity out of a wave count. Now, if you look at a particular chart and you have to scratch your head so much to make it, try to see an Elliott wave, then you're in a correction, move on. Don't even try to trade it, okay? Just move on to something that's more clear. So the modern approach, however, and one that I created an entire home study course around, is one where the idea of connecting the dots using more than just wave structure. And so we do use the classical approach, okay? But like I said before, this is what has made wave forecast so accurate for me over the last 20 years of trading is because I combine the classical and the modern approach to increase your odds of success. I also have something I created called the Elliott Wave Probability Matrix, where I actually assign a percentage accuracy based on the variables I'm looking at when looking at the Elliott Wave. So some of the variables I look at: classical approach, fib levels have to be met in terms of certain pullbacks have certain fib levels that they have to fall into before they are considered a high probability wave count. We use the OWL histogram indicator to confirm Elliott wave counts using momentum. All right, so we have all that kind of stuff. Fractals in the market, every time you have a change in behavior, you have a fractal which forms a smaller wave count inside a dominant wave count. Volume confirms Elliott wave count. Price compression, do we see channels or pennants during corrective waves 2 and 4? And then we assign percentages to these types of things that we're observing, and it's pretty specific how we do that. And then, of course, you always have to use risk control when trading out of this. So you need to connect enough dots to make sure the trade, all right, has a high probability of success. All right, so does it work? We've been using it, again, for a long time, and it's pretty, I find it pretty amazing. I was using it back quite a while ago, and one of the interesting things here is, here's a stock. I also used it back quite a while ago, and I have a chart, I think, from the year 2000, where we caught the .com bubble just perfectly with an Elliott wave, wave 4 on that. But I'll get to that in a minute. So here's one on a stock, and again, using the modern approach here, we use the OWL down here that helps us identify wave 3. The OWL on wave 3, on a bullish wave 3, will be one of the highest OWLs in the sequence. Wave 4, which is your ABC correction here, all right, has to have a red owl. Wave 5 has to be green again, and you have to have bearish divergence between wave 3 and 5. So when we take a look at this here, okay, we got a scenario 1 up here, probably 2, nice big move here to 3, probably right around there, 4 and 5, we finish. Then we go into an A, B, C, and then we finished with 5 in the target zone. So fibs came in to be a very important role here. Here's 38.2 to 61.8. So we expect wave 4 to reach that level, and it did. So that's a dot connected. We expect the owl to be red during wave 4. That's a dot connected. We expect wave 3 to have the highest momentum, dot connected. We expect the price action in 3 to have 5 waves in it, dot connected. We expect wave 3 to be hyperbolic in nature compared to the other waves, check, dot connected. We expect wave 5 to create a green colored owl, dot connected. We expect the target zone for wave 5 to be 61.8 to 100% fib extension, dot connected. Okay, so that's what I mean when I say we try to connect those dots and then add a probability sequence. All right, so that is it. Now, Chris is asking an excellent question. So if the owl on wave 5 is not lower than this, it becomes the new 3. Okay, so that means that this is a 1, this is a 2, you're going into a 3. That's what that would mean. And that happens sometimes, but you're never going to know it until it does. All right. But the nice thing about that, if you're trading wave 5, Chris, guess what? You're still going long in the direction. If this turns into a wave 3, you'll do even better. So it's not hurting you. You know what I'm saying? So that's a great question. All right. So there is one example. Here's another one, a trend down. Markets don't always move up, obviously. All right, so, a 1 down, 2, 3, deepest owl, 4, 5, target zone, fib retracements used, 3, 4, and 2, 3, and 4 to give you the target. Okay, so that was one example. All right, now let's see what else here. Okay, here's another one, different chart altogether, PEX on a daily time frame, and again, dots connected. Wave 3 owl the highest, wave 4 has to be negative, wave 5 has to be bullish, and it has to have bearish divergence, target zones of fib extension, target zones of fib retracement, and you can count the waves inside the smaller type of thing. So here's wave 1, 2, all right, major, now you got 1, 2, 3, 4, 5 that make up wave 3, your ABC correction, okay? Now, if you look at a chart and you can't really see it, it's not quite there, then chances are you're best to move on to something that is more clearer, okay? Yeah, you could try to figure it out. You could go to, many different time frames and, re-engineer it until you figure out where you are. But it may just be easier to keep on until you find one that's clear, because there's so many stocks you can look at, or markets, any markets for that matter. So, kind of keep that in mind. Just depends on what you personally want to do. But it's really cool when it's very clear, because and you can't miss wave 3. Wave 3 is just so hyperbolic. Now, the nice thing too is if you see a wave 3 and missed it, that's okay, all right? Wait for either trade wave 4, okay? Sometimes trading wave 4 is good, sometimes it's not, depends how early you can get in, and depends on the risk to reward to the target zone. But just wait until it gets to 4, then you know you're going to be in 5. And as Chris says, if 5 turns into 3, ooh, that's even better, right? So that's the way I would do it, okay? But you can see when you have things clear, everything lines up nicely. And when it doesn't, then chances are you're in a complex correction, or a correction of some type on a higher time frame that's making the current time frame messy. All right, here's another example. All right, a 3 down, owl plus 5. Okay, bullish divergence. All right, and in this particular case, we use it with the ART system and the PTF. So those of you using our software, we use it with the Elliott wave all the time. So if you were sitting right here on current prices and your stop is way up here, you might be getting a little antsy because your stop's going to be up at 33.5 and you're sitting here at 29. The thought is going to come to your mind, I've got bearish, bullish divergence. Let's see what we got. 1, 2, 3, 4, 5. Is that the right count, or is it more like this? 1, 2, 3, 4. And so what do? All right. Well, if the PTF is red, chances are you got one more low before it's over. So you may want to scale out a little bit, okay, if this goes green before you go back down. But there's many, many ways that you can do it, but you are nearing the end of the trend regardless. So a lot, just knowing that helps you a lot in deciding what you want to do with the trade. Now, the next chart here is one that goes back, this will date me a little bit. This was, back in 2002, but the interesting thing is that in the late 90s up in here, okay, this was 98, I think, because that was the big pullback and the last move up. So we knew we were in an Elliott wave 3, and the inside wave count had us on Elliott wave 5 right around 99 to 2000, okay? So we knew we were due for a break in the market. And this happened to be the .com bubble break. They always tell you after the fact what it is, but that's what it was. And one of the key indications is, we broke below this low here. When we had this pullback here, we did not even break below these two support levels. So that was an indication that we were still in the major impulsive wave. If he had come down here, then that would have been different, but it didn't happen. But here it took it out right there, got compressed and kept taking it out. So the trend started to shift down. And so we drew the fibs in and it put it right here, right in this area here between 85 and 7,000, okay? and it ended up coming right down to this circle here for the retracement of that particular sell-off. And the interesting thing about the Elliott wave is this: during an impulsive move, the good news is extenuated, creates a good move. During a sell-off, the bad news is extenuated. The mood changes. So what does that mean? Well, it means during a good bullish impulsive wave, all right, any news that's good is good, okay? It creates a higher price. Any news that's bad on a correction or a bearish impulsive wave creates lower prices because the mood's changed. Now, what's interesting is that usually the first initial crack, okay, in a wave 3 is usually associated with something. All right, back here it was the dot-com bubble. All right, where we are now, okay, is inflation and interest rates going up and things of that nature, okay, the supply chain, all that kind of stuff. So that usually creates the first movement down. Then you have some bullishness like we're seeing in the market right now, and that's B wave. All right, B wave can be quite bullish. And then something comes out of left field that causes C wave. And then usually it's something we don't see coming, all right? And that's the scary thing about C wave. In this scenario, back in this time frame, it was 9/11. Okay, 9/11 created this thing to head on down. So you never know usually what comes down, but it is severe, and it needs to be severe enough to reach those fib levels. And you know, it's amazing. Don't ask me why or how these things happen, but they do. And don't forget, this first A wave down usually catches people by surprise because, yeah, they know that, you know, the dot-coms are kind of not doing that well, but, you know, they're still kind of popular, and the market kind of trickles down, and people really don't, until they start taking out these support levels and you're down about 30%, realize there's a problem. It's kind of like what happened this year. All right, market started pulling down, and all of a sudden, you know, if you didn't realize that we were going into a major long-term correction, you might just think it's a minor pullback and a continuing uptrend. So this is where the Elliott wave can help us distinguish between that and a correction of significance. And so when you start taking out support levels after a big bullish wave up like we've had since 2009 here, and they start taking out support levels, which it certainly did, then you know things have changed. All right, so that's kind of what it is. But the nice thing about B wave, it allows you to reorient yourself. And if you you know, want to start liquidating some of your long positions in B wave, talk to your financial advisor, come up with a game plan, come up with a low. All right, in other words, if B wave's going up, then eventually if it's going to give way to C wave, it's going to come back down. So have a number in mind when it comes back down on C wave that you may want to think about liquidating some things or not buying back into the market and instead waiting. Because if you do go into a C wave and you get down here, all right, cash is king. So if you can liquidate some money and then put it back to work after the correction, that's the way to do it if you can do it. But usually when you get to wave 4 on a long-term correction like we're going to be in now, either nobody's going to have any money left, or they're going to be so sick and tired of stocks, they're not going to want anything to do with them. Of course, that's when it bottoms in. Okay, so that's kind of, you know, again, the Elliott wave, if you understand how to use it and how to spot things, can really be, once again, the roadmap of the market. So let me just see, if you want me to type in some symbols, some charts, what I'd like you to do is come back to the client support next Wednesday, because we do that. But more importantly, we're now on YouTube every Friday. So if you tune into our live YouTube channel, all right, every Friday at 8 a.m. Pacific time, I do nothing but look up your symbols. And so if you are interested in that, please come to that, and I'll be glad to do that. We like to keep these webinars kind of on the short side here. So let me just see if there's any more questions coming in here. Yeah, volume is one of the telltale signs of a wave three. You do have the highest volume. Yes, that's correct. Okay, on wave three, but so is momentum. Okay, momentum is also representative in that area as well. All right, well, let me just go ahead and finish up here because we're kind of moving on here. So we put together, if you're interested in learning more about the Elliott wave and learning how I count the waves, how I apply a probability matrix to the count, this is a great course and at a great price right now because we want everybody to be using the Elliott wave. It's that good. So check this out. Gene will put the link in the chat area and I will leave this up here. But if there's no more questions, let's move on here. Yes, Chris is asking, any final closing remarks on today's Diamond and or Dow Jones Industrial Average and the S&P 500? Absolutely. So Chris, based on the weekly charts, we feel that the overall Dow as well as the NASDAQ and all the major indexes now have entered a long-term correction. We've, I think, experienced a wave, and we're not quite 100% sure a wave is over yet. It has to go above like 33,000 before it to be over. And it's getting close, but it hasn't. It could still take one more dip to the downside. So we're kind of staying vigilant on that. However, okay, I can tell you we have gone long on a number of stocks over the last week or two. So that's usually an indication that a wave could be over. All right, so we've taken those long trades on those. Now, B wave, which is what we're in now, is a long-term B wave on the weekly chart. If we're correct, that B wave could last months. So we could see bullishness now for quite some time. B wave is tricky. Maybe it'll last a month. Maybe it'll last 2 months. We'll have to see. But anyway, when it rolls over, okay, the owl will roll over and tell us when it's over. But for right now, you should enjoy the ride up on B wave. Always use stops on B wave because it ends quickly. So you know, just ride it on up. You can use your Elliott waves and figure out what's going on inside B wave. Okay, but there you have it. And so after B wave, then we have C wave, and that's going to be a monster. That's going to bring, I think, the markets down to about the 18,000 level, possibly maybe a little lower. But that's going to be a monster of a sell-off, probably in the latter half of 2023, maybe bleeding over to 2024. And then after that, the correction should be just about over. And then you'll have a bullish wave 5. When you get down to that wave 4, if you can have any cash stashed away, that's your black swan event, because that's when you're going to be able to blow into some really cheap stocks and ride it up for quite a long time. Now, the other thing too, for example, on the Dow, we're short the Dow in terms of the long-term weekly charts. We put out a short signal on that, but the stop is far away. It's close near the top, okay, because we're going to ride out B wave on those long-term trades and then dump it if it gets down to C wave. But you can also do shorter term trades on the A, B, and C wave as well. So you can make a lot of money on shorting C wave, and you can make some money on B wave right now too. But that's where we're at overall, okay? So a little bullishness for right now. And we'll see if we get above that 33,000 level. If the market turns south in the next week and makes one more low, then that will be the bottom of A wave. Otherwise, A wave bottom might be in already, okay? Hopefully that helps. All right, well, I want to thank everybody for coming today. Great turnout. Definitely pick up the course if you want to learn more on Elliott wave. We give you a lot of, there's video in there, and as well as a lot of exercises for you to practice. We also go over how to draw fibs properly so you get those high probability fib levels that we look for when we connect the dots. All right, so thanks so much, everybody. Gene, back to you.
Terrific. All right. Well, I always love your Elliott wave analysis, and I'm just now posting a link to Stock Analysis Fridays. So I know Jerry is here from Australia, and I have a feeling You probably can't come to this one, right, Jerry? Because you'll be sleeping. But it's 8 a.m. Pacific time every Friday on YouTube. The link is there. Those of you who are in the room now, maybe give me a shout out and tell me if yes, you've been there or not. But if you haven't, we'd love to see you. So I guess that's it for now, and we will see you for the next Wednesday Night Live, which is the fourth Thursday. I'm sorry, let me start again. It's the fourth Wednesday of every month. So we'll see you next month, and have a great night.
Gene, one more thing I wanted to throw in there about stock analysis Fridays. One thing is that, you know, we're starting to get a lot of people to come to that. And so we ask people to bring a few stocks when they come, because the idea is that almost now is turning into a stock picking service. If everybody brings a few stocks, I go through them, we're usually able to find quite a few good ones to trade. And they may be ones you're not aware of. So it's kind of neat that way. And then of course we record it too. So make sure you subscribe to our channel, and then you can watch the recordings. Okay, so that's it. All right, so we'll see you next time. Bye-bye.